wants to admit it. The market is at all-time highs. You're sitting there watching this video thinking, God damn it, Leonardo with another bearish prediction. But that don't make me wrong. And those of you that are watching this right now, you're thinking, damn it, you're wrong, Leonardo. You just told us to short Tesla. And we did. And it just kept going higher. And we will talk about this in just a minute later in this video. But for right now, let's focus on the bigger picture. Weaker dollar will kill the U.S. consumer and cause the market crash by April 2020. Yes, within the next 90 to 120 days. Sometimes the tops take their sweet time to form. But just because some of the facts that we have shared lately on this channel did not produce the crash, it does not mean that one is not coming. And because I am highly alert about all the divergences developing all over the place, and just because the market has not tanked yet does not mean that it won't in the next 90 to 120 days. With that said, guys, it is paying attention to things that nobody is actually talking about that will help you nail the next market move. So it's not a question of whether Leonardo will make money on this crash. It's a question of whether you will make money on this upcoming crash. The circumstances has been never better, and many will consider me a fool for recording a market crash video while the market is so freaking bullish. It continues to make all-time highs a few points each day, higher and higher and higher. But I will show you at the end of this video one very important chart that will kill any arguments that you may have about the upcoming crash. So for now, let's focus on the facts. We're about to reveal where everyone is wrong about the estimation that the consumer is in great shape. Now, this is exactly what has been driving this market higher and higher and higher. If you talk to 99% of the analysts on Wall Street, that's the only thing they got to say. Oh, well, the consumer is in great shape.
I think the consumer is fine. They're in great shape. But
the consumer. Steve Leisman joins us now for a little check on the health of the consumer. Steve.
Morning, Andrew. Will it be a bah humbug or ho-ho-ho holiday? Consumer looks to be in good shape.
Have a good shape. Better shape now than it was in 2008. Great shape. But we'll have panics in the future.
Now, here's what's actually going on with the consumer. The consumption is dropping off, and I'm about to present some evidence of that. Now, nobody on Wall Street wants to acknowledge this right now, but they all will be talking about this in the next 90 days. As a matter of fact, there's some things that we'll be talking about in the first week of January that will potentially prompt this market to drop by 5%. The first week or the second week of January could be a huge drop in the markets for some reasons I'm about to present later in the video. But for now, focus on this. Consumption is going lower. We have just reached a peak in consumption. The fact is this. Retail sales just hit 7 months low. How the fuck is this possible? Didn't we just have the big shopping spree going into Christmas? The Black Friday. All of this should not be producing a 7th month low on retail sales. Retail sales should be going higher and higher. You may be thinking, what is the big deal? Well, how can we be hitting 7-month lows on retail sales when unemployment is officially at the lowest levels in 50 years? Guys, this is a divergence. Now, you may be thinking, Leonardo, you've been talking about divergences in so many of your videos lately. Guys, this is something to pay very close attention to, okay? While the music is playing and all the analysts are dancing, okay, it doesn't mean that the music is about to stop. When they hear music and they dance to the tune of the fad, it doesn't mean that the party can be over within seconds. And again, I will show you one picture that is worth 1,000 words at the very end of this video, which should erase any doubts you may be having about the upcoming market crash. So why is no one listening to Home Depot? This is ridiculous. Home Depot goes out there and makes a point to be 100% clear and transparent with the investors and says sales are going down next year. This is presented in the chart in the initial reaction, but the market has short memory. Guess what? They're already forgetting about it. So Home Depot from 237 all the way to 209, now back to 220. So all of a sudden, everybody forgot what Home Depot just said. Now, why would this be important, guys? What Home Depot says in their earnings calls has great importance and value. I'm going to walk you through this cycle, this spending cycle that the typical American person will go through. So first, you buy a house. So here's your step one. First, you buy the house and you max out your DTI, debt to income, to buy the damn house with a mortgage. Okay, second thing you do is you go out there before that loan actually hits your credit score and before that big loan actually shows up in all 3 of your credit bureaus, okay? You apply for a ton of credit cards, okay? And you go to places like Home Depot to buy all the useless small shit that you really don't have to have for your house. And you max those credit cards out at Home Depot. As a matter of fact, if you go to Home Depot, they got their own credit card. Chances are, you got it pretty much maxed out by this point. So first you buy the house, then you buy a bunch of useless shit that you don't really need. First of all, because the economy is so great, you're buying a house that you really don't need. You're buying a house, a 4 or 5 bedroom house where you really need a 2 or 3 bedroom. So you buy extra stuff that you really don't have to have. Then you go and you put a bunch of more useless stuff in your home that you really don't have to have. This is where the party ends. Okay? Then, after you max out your mortgage, after you max out all your credit cards, you realize that, hold on, now they're sending me all these bills and I actually got to pay for this shit. When this light bulb of realization finally hits you, okay, this is when you actually start slowing down on your spending and consumption. So we just hit this light bulb point in the market and nobody is actually freaking talking about it. Which creates one of the biggest ever shorting opportunities in the history of the US markets. So that's when you realize, hold on, I got all this stuff I really don't need and now I got to pay for this shit? Well, hold on, nobody was telling me that I'm actually going to have to pay for this shit. And now you're thinking, damn it, why did I get all this stuff? Do I really need all this to be happy? No, I don't. So right about this time, you're like, yeah, I don't I don't really need all this stuff. So you slow down on your spending. This is exactly what's happening right now. I'm going to show this to you guys on the next few charts here. And officially, right when this actually takes place, this is the best time to be a bankruptcy attorney in the history of the United States.
Heard you're having money problems.
No, you didn't.
Listen, I got the answer. You declare bankruptcy, all your problems go away.
There's going to be more bankruptcy in this country. Unfortunately, I hate to say it, but you have to understand what's actually going on in order to understand how to trade this market going from here forward. So, if maybe you're just getting out of school, this is a good time to be a bankruptcy attorney. If you're thinking like, what kind of attorney should I be? Damn it, become a bankruptcy attorney, because the demand for bankruptcy attorneys are going to skyrocket in this country.
I declare bankruptcy!
In the next 90 to 120 days. Now, here's the deal. You would think, why would you have a chart of Lulu here, Leonardo? Well, because exactly what I have just showed you on this cycle, illustrating the house and the Home Depot example, this is exactly what's happening with Lulu. Now, you may think, okay, there's different numbers here, there's different stuff going on, but in reality, Lulu stock peaks at about the same time as the Home Depot stock, which coincides with the top consumption peak cycle of all times. Okay? So here's what you got. You got the top right here. The stock drops. You got a big middle finger action going on right here. For those of you not familiar with this proprietary term we use on this channel, middle finger basically tells you that there's further drops in this stock because of the volume characteristics portrayed in this chart, especially when it coincides with a death cross on the MACD. Basically, to put it in simple terms, okay, all of a sudden, your girlfriend, or your wife, okay, when they go shopping at Lululemon for a pair of yoga pants, okay, this is what you tell them. Honey, do you really need to have these yoga pants in all these colors? Like, for real. Like, you don't need all these colors, honey. What you need is to learn how to use the damn laundry machine. Okay? So instead of maybe buying 3 or 4 pairs in multiple colors, you just tell her, look, just get one and wash it every other day. Bottom line, this is exactly what the chart of Lulu actually represents. So the fun part is over. Now, institutional investors are slowly leaving the party, but the stock is up 300% in the last couple of years. Okay, this is a peak in the spending cycle in Lululemon. Okay, so we got Home Depot, home appliances, everything you need for your home coincides with the peak in the Lulu stock, where basically it's just sportswear, for people that like yoga and stuff. How can these be so coincidental? Well, maybe it's not coincidental at all. Because if we look at Costco, fine. Okay, forget about yoga pants. What about the basics? Costco is topping out too. Top 1, top 2, top 3, top 4. Nobody's paying attention. Finally, we're under the blue line. Middle finger action. Do you understand this is the same middle finger action I have just shown you on the Lulu chart? How can this be possible? It is possible because it is the top of the spending cycle. It doesn't matter which retail stock you turn to. This is what's going on. This is the top. And everybody's still making the assumption that the stock market is going higher because United States consumer is intact, which is totally wrong assumption. United States consumer has been deteriorating for months, which is proved by lower retail sales, which is proved by these charts. Now, what is the big deal with Costco? Costco has been the holy grail of retail stocks. So why are we seeing such huge volume on the distribution side, meaning people getting out and selling the stock? Well, here's the deal. Something to think about. It's okay if you spend less on your mistress and you buy her 1 pair of yoga pants instead of 3 or 4 in different colors. But here's where a real issue lies. Okay, if you start spending less on your family before Christmas. We're hitting 7th month low retail numbers before Christmas. That is a sign of a consumption top. You don't go to Costco to buy extra pair of yoga pants. You go there to buy the basics that you need for your house and your family. And if you're not convinced about the Home Depot, the yoga pants, or Costco, what is going on here? Amazon. Market is hitting all-time highs. Would Amazon be a good barometer of how healthy the United States consumer really is? Apparently not. The stock is off its all-time highs by about $350. Guys, this is not a joke. This chart has nothing bullish going on for it. It's in a death cross. Okay? It's struggling. It's every rally stages to the orange line, which, guys, if you've been a subscriber to the 13 Markets Move daily videos, you would have known that we've suggested shorting Amazon every time it touched the orange line, and we've shorted it promptly, and we made a bunch of money on these trades. Guys, this is not a coincidence. You may be thinking, Leonardo, what the hell is this? Guys, this is a trajectory of inflation. If you look back on all the videos we've posted on our channel, about 13 months ago, we were the first ones to talk about deflation. We were the first ones to talk about interest rates dropping. While the popular opinion on Wall Street was that the Fed was going to raise the rates 3 months before it actually happened, that Fed happened to lower the rates, we said that Fed was going to lower the rates instead of rising the rates. So we were typically running ahead of what things are actually going to do. So inflation is about to rocket higher. Now, there's certain things that are very basic when inflation goes up. The Federal Reserve is going to have to save its ass, meaning they will have a definite struggle to maintain things where they are right now. Now, let's look at the details. Nobody wants to admit that the inflation has a solid uptrend. Here's the data on the inflation, 2015. Just a decimal point. 0.1, 2.3, 1.3, 2.1, 2.4. Guys, do you get the fucking point? Inflation is uptrending. For those of you that like to visualize charts, here's an easy explanation. After this deflationary stage, we set a bottom right here in the chart. We create another bottom right here and another one just now. This is a solid uptrend. The inflation is about to break out. Now here's the paradox. Okay, here's the greatest paradox that nobody seems to be paying any attention to. Despite of the lowest interest rates in the history of the United States, let's just take it back a little bit. Last year, on a 30-year fixed mortgage, we're looking at about 5%. This year, it's about 3.8%. Here is the paradox that nobody's talking about. Home sales are down. Based off the last data that was released just a day ago, home sales are down. The question is, if we got the lowest interest rates in the history of the United States combined with the highest employment within the last 50 years, why are the home sales actually down? And more importantly, why the prices are up. Officially, median home price is the highest ever we have seen in the history of the United States. It's around $272,000. That's what an average house will cost you this day, guys. I mean, forget about, certain areas where median house prices are like $500,000. I mean, there's certain areas you can't even buy a house unless it's $800K. So here's the situation that we're really talking about. So while the consumer is actually weakening, the prices are up. Now, the prices on housing up, that's the first indication of an inflation. Okay, so inflation is going higher while consumer is actually getting weaker. That is a death cross of its own that nobody is talking about, that leads to a crash that nobody wants to talk about yet, but they will be talking about it. To sum it all up, guys, how will lower consumption combined with high inflation impact corporate profits and margins. They are going down. Corporate profits and margins, guys, they are going down. And so is the market. So let's take a look closer at some data. Let's take a closer look at some facts. CarMax. Why would CarMax profits fall? Now, this is from CarMax earnings call just a day ago. A day ago meaning Friday, December the 20th, 2019. If everyone is pretty much employed in this country, okay, I mean, let's say not everybody's got a, 100K or 200K job, which would entitle that, those that probably have a 100 or 200K job that go buy a new car. But, considering we pretty much got everybody employed based off the numbers that we're shown, okay, wouldn't that mean that everybody needs a car to get to work? Like, it doesn't matter whether you're making 30 or 40 or 50K a year, right? I mean, wouldn't you need a car to go to work? Since CarMax is selling not brand new cars, but they're selling slightly pre-owned cars last few years, right? Where you can get a lower payment compared to a new car. Wouldn't that mean that CarMax profits should be moving higher? I mean, considering the fact that CarMax actually set some record sales. They actually went from selling 4.3 billion cars to 4.8 billion cars compared to last year. And with that, they have managed to actually make less. So rates are at all-time lows, which would be a great situation for people to go and get a car loan. Unemployment is at record lows, which would be a great indication that more people would want to go and get a loan. But all of a sudden, CarMax makes less money. What is going on here? So if it sells more cars, but it makes less money, what do you think happens to the stock? Well, this is exactly what happened to the stock. So CarMax, we actually recommended in our 13 Market Moves daily analysis video to buy CarMax puts, 100 strike puts. So on that news, initially, I mean, can you even freaking imagine this? Initially, CarMax stock goes higher. Then it drops like a rock. Everybody realized, well, hold on. If you sell more cars, shouldn't you be making more money? Well, apparently not, because of the inflation rocketing. So here it brings us to the very important subject of the day, Tesla. Tesla investors getting high with Elon Musk again? Apparent answer is yes. And another simple question is, if Tesla sells more cars at a loss, would that turn it into a profitable company? And the obvious answer is no. So you have to be absolutely high on Elon Musk and Tesla to believe that a recent 20% price cut for cars Tesla will make in China is actually a positive for the company. Because this is exactly where the company is going. If you sell more cars at a loss, you can only do it for so long. So you're going to have to borrow money. There's two ways Tesla can borrow money. One is by offering extra share offerings. The more shares are available, the more shares are outstanding, the less the shares are worth. And the second thing is, issuing bonds, which Tesla officially has got a junk bond rating on their bonds. So Tesla stock is not going to the moon, guys. It is going to Mars.
Elon Musk mistook the moon for Mars in a tweet, and the internet is calling him out. According to Business Insider, the SpaceX CEO tweeted a picture of the moon with the caption, "Occupy Mars."
Because apparently everybody thinks that Tesla cars will be maybe flying to Mars in the near future or some shit like that, because that's the only way to explain the stock trading at 404.48 left. Now, I know some of you are watching this, but Leonardo, you've recommended shorting Tesla at 387. But you should also know from many videos we have placed on this channel how to steer step in your trades. Notice that nowhere in the prior video did I suggested go all in on this Tesla trade. You should know what percentage of your account goes into a trade. So we should not begin a bunch of people losing money here, because ultimately if you would have nailed the top at 413 on Tesla yesterday, those puts actually produced 405, 400 level puts produced over 300% return. So if you steer step, let's say at $500 increments over the course of the last few days, which we did state in the last video that, hey, just because the charts point to a divergency and a high probability of Tesla stock dropping from here based on the historical data, Okay, we still think Tesla stock could be going higher. So that right there, guys, tells you that you shouldn't have gone all in, bought a ton of puts. You should have diversified your trade by multiple different strike prices, by multiple different expirations, and ultimately by stepping into this trade, you should have not locked in a loss. The very worst outcome of this trade should be breaking even. Now, if your actual outcome on the Tesla trade was a loss of any kind, you should review the last 400 videos on this channel so you would understand what stepping is. And clearly, every time, guys, I'm recording a live video for you to show these trades, you should know that it doesn't take $100,000 to make $100,000. Okay, most of the trades I show you with 2K, 4K, 6, 10K, I mean, that result in profits of $20, $30, $60,000, you guys should know that you should only trade a percentage of your account in order to accomplish these huge gains. So the bottom line is this. Most of the analysts are so freaking bullish on Tesla stock. Why? Because they think that all of a sudden Tesla is going to sell 50,000 cars a month in China. They're going to sell 100,000 cars, 150,000 cars. Guys, it doesn't matter if Tesla sells 500,000 cars in China a month. If it keeps losing money on every car it sells, okay, it's not going to turn it into Amazon. You're thinking Amazon's been losing money for years. Yes, it has been doing so on the retail side, which is exactly what Tesla is. The only reason Amazon is the type of company that it is today is because of its cloud business. Have you heard anything about Tesla having any part of its business making a profit in the cloud sector? You're going to say, but Leonardo, last quarter, they have manipulated the numbers and they've showed a profit. Yes, and guess what? They're not going to be able to do it next quarter, and they're not going to be able to do it next quarter. So the situation for Tesla is the best situation you can ever wish for if you are a short seller, meaning if you make money when stocks drop. Now, could Tesla still go a little bit higher from here? Yes, but use that as a shorting opportunity, okay? It will keep losing money. It will keep losing more and more money. It will have to issue more stocks. It will have to issue more bonds. It will have to borrow money again and again and again. At some point, this bubble will pop. Considering the data we have just gotten from CarMax, which the reason I'm bringing this up is to make a point that the margins in used cars are substantially higher than the margins in new cars. Since Tesla is dealing with new car sales, 20% cut. Do you understand what the fuck that is? It's like a Model 3 typically would sell for $36,000 in China. 20% cut is like $7,200. Okay, $7,200. They're going to sell $28,000, $29,000 Model 3s there. That cost them to make about 40 grand. Okay, you tell me what kind of business that is and how long they're going to be able to keep that shit up. Not very long. So the drop in Tesla is coming much faster than anyone is realizing. Now here's the one catalyst that many choose to overlook right now about the market could actually start moving lower the first week or the second week of January. And the reason for that could be a quick revisit about the fears of the repo rates that the banks charge each other. In September, we had a crazy situation where all of a sudden the repo rates, overnight rates that the big banks charge each other, went from 2% all the way to 10%. So the problem actually still exists. The Fed had injected a ton of money to prevent this problem short term, but the long-term problem is still here. So this is the situation. It may be a little bit easier to visualize it on this chart. So basically, this chart shows that more than $320 billion of total repo market support from the Fed since September 17th. Now, at this pace, guys, the Fed may be able to keep this up for another 90 to 120 days. But guess what? After this, the bubble will burst. Here's the societal paradox. Plenty of credit and not enough cash. Why do you think Fed has been placing all sorts of limitation on cash transactions, guys? Because only fake money is real in this market. But even that will come to an end. This is the chart you should be paying very close attention to. Our projections for the next 90 to 120 days, for the next 12 months, for the next 24 months, is that the US dollar will tank. Here's the chart portraying the top of the US dollar right now. This is hugely important, guys, because if the US dollar tanks, then the whole theory of the United States consumer being so strong and powerful to keep this market moving higher and higher to the moon, all of a sudden, that is no longer the case. If US dollar drops, so will the US consumer strength buying all the goods from China. We're not going to be able to do so. If US dollar depreciates, if the US dollar goes down, so will the US consumer, and so will the market. Now, let's break it down in a little more detail. US dollar goes down, what happens to inflation? Inflation goes higher. This creates a huge dilemma for the Fed. They gotta keep the rates low to be able to make the interest payments on the bonds that they keep issuing. So here's where the market drops. Once the market participants come to a realization that because of the US dollar drop, the inflation is going to have to go higher, and with the inflation going higher, the Fed is actually going to have to raise the rates. And if the rates are raised, even by a little bit, we've seen it in the history. I'm about to show you the chart. Stay with me for another second, damn it. US consumer is going to drop. Rates go higher. Guys, already at the lowest rates in the history. Home sales are down. They should be up, but they're down, okay, because of the prices in the homes. So the inflation in the housing sector is already up with the lowest interest rate. Who is going to be able to afford this median house of $282K if the rates climb higher? The prices, like there's a crisis coming in the housing sector that nobody wants to acknowledge. If the rates go higher, okay, everybody's already maxed out on their credit cards. They're not going to be able to maintain the payments. Everybody that's already refinanced their house, guess what? They did that because they couldn't afford the damn payment in the first place. Now, there's no alternative to refinance it lower. The rates are going higher. They're stuck with that payment, okay? If the inflation hits the market, guys, the consumer dies. Inflation higher, rates higher equals consumer lower. And since the whole theory of the stock market is based on the strong U.S. consumer, when the U.S. consumer falls, so will the market. Here's the most important chart in this video, guys. We are extra close to the same market conditions that were created in December 2017, January 2018. Now, at the time, the catalyst for this move higher in the markets was the tax cuts. Right now, it is the strong U.S. consumer. Nobody expected this 10% drop in the market at the end of January 2018, but we nailed it. Why did we nail it? Because we paid attention to the chart divergences. We paid attention to other divergences developing in the market, just like we've been doing over the course of the last few months. A bunch of institutional investors went out of business where we made a ton of money. So, okay, fine. You may be doing well with the markets right now because you're a bull. But do not underestimate the market actually doing this in the near term. Everybody was so complacent right here. The VIX was around 11, 12 as we were going through these type of market conditions in January 2018. And all of a sudden, January 25th, 26 hits and we make a gap lower. And everybody thinks buy the dip. And those that did buy the dip, they're no longer in the stock market. Now, from the standpoint of trading short-term options, these are the greatest opportunities the market can present you with. Because when you're trading weekly options, you want the drop to come quick. And the stocks drop much faster than they climb higher. So get ready, because this is what's about to take place. Now, be wise about it. Stair step in your position. You want to learn more about stair step in your position, take our courses. They will definitely help you guys out. If you don't know how to short the market, maybe you're good being a bull. Maybe you're natural about being a bull, but you're just like, man, I've never made money on stocks dropping. Guys, the opportunity is absolutely phenomenal right now. We have never, ever been at this historic highs in the markets ever. And with historic highs in the market, we're destined to get historic drops in the market. So position yourself wisely, learn the skills on how to short stocks and make money when stuff actually falls. So you can set yourself free and do whatever the hell you want in 2020. I dare that you would set some records. I dare that you would become the best trader you can possibly be, making money on the bull side and even more money on the short side. With that said, I wish you Happy New Year. Happy Merry Christmas to everybody. And don't underestimate your ability to be a great trader. Make it happen. Click the link below. Get more education over the holidays so you can trade fearlessly and get to do things you've always wanted to do that you've never gotten to do in 2020. Let's roll.